The S&P trading higher today and on track for its sixth weekly gain in 7 weeks. But will stocks continue to march higher, or is a correction coming? Joining us now is Cameron Dawson, Chief Market Strategist of Fieldpoint Private, a boutique wealth advisory and private banking firm. Cameron, thanks for joining us here today. So I guess that's a great place to start. Mike Santoli started off the show by saying, yes, we've had some fits and starts, but the uptrend is really holding for the S&P 500. However, it sounds like you think that's not going to be the case for long. What do you make of what's coming?
Yeah, so I think the first message is don't panic, because a 10% correction is likely not enough to raise big cash balances and incur capital gains, but it is enough to be patient putting new capital to work in the equity market. So we think that there are two camps of drivers that could be driving a correction. The first one is technical and the second one is fundamental. The technicals are pretty straightforward. We know we're in year 2 of a recovery, which is always choppier. We also know that we have some tough seasonal headwinds. You add on top of that fading momentum and fading breadth, and the technicals do raise some questions. The fundamentals might be a little bit more interesting for investors, because we think that we have to appreciate that we have a fading tailwind from both fiscal and monetary policy growth. If we look at things like M2 money supply or the Fed balance sheet, that growth is slowing substantially. So when you add on top as well peak data, so things like peak PMIs, peak car sales, peak housing sales, that should provide a headwind as well as a stronger dollar, which will tighten financial conditions and possibly create higher volatility. The last thing to remember is that earnings expectations are really high. We've actually seen the largest increase in earnings expectations going into this second quarter earnings season on record. So at an all-time high and with record inflows into the equity market, we think it's a rather hard environment to surprise to the upside.
And you also think it's going to be really hard to make money in cyclicals, and you're watching machinery versus waste stocks. Explain why this is a metric you pay attention to.
Yeah, this is a fantastic one, because what it does is it looks intra-sector, and it says, instead of saying all industrials are cyclical, because there are some that are defensive, what we say is machinery stocks are the most cyclical of the industrials and waste stocks are the most defensive of the industrials. And what's really interesting here is this ratio peaked out within days of the PMI hitting a 40-year high. So when we hit that 40-year high in the PMI, cyclical stocks were trading not only at all-time high valuations, but they had just rallied over 150%. So this gets us to one of my favorite mantras in cyclical investing, which is, when the going gets good, we get going.
What, Cameron, what level of pullback would you need to see of the headline indices to advise your clients to be buying U.S. equities fairly aggressively again?
Well, we think a 10 to 15% pullback is still viable. We don't see something more nefarious coming, because credit remains, fairly benign here. We haven't seen credit spreads blow out in the past week, despite all the market volatility. And so, and let's not forget, the high yield spread, when you take out CPI, so on a real basis, went negative. So the market doesn't seem to be anticipating some kind of economic recession. And cycles simply don't end when saving rates are this high or the inventories are this low. So all in, I think a 10 to 15% correction is certainly viable.
Cameron, let's get your take before we let you go on sort of the FANG groups, these mega cap tech stocks. Obviously, President Biden putting in this executive order today asking the government to take a little bit closer look at the way that we've viewed these companies and their ability to grow and compete. What do you think that or other factors will mean for these mega cap tech groups, the FANG stocks and sort of surrounding members?
So we've seen the FANG stocks be able to be rather impervious to any kind of regulation. The reality here is that the profit that they're able to make far trumps the amount of fees that they have to pay, against the regulations. We also think that FANG stocks are getting the benefit of the defensive inflows. FANGs are the new defensive because they proved in 2020 that they can be the all-weather stocks. So you're not seeing money flow into things like utilities and staples like you might expect when yields come lower. It's going into these small cohort of idiosyncratic growth drivers.
Cameron, thanks so much for joining us. Good to see you.
Shepard Smith here. Thanks for watching CNBC on YouTube.